Welcome back to the Wall Street Exclusive Daily Show. So we talked about if you're an active investor, look for those sustainable competitive advantages. If you're a passive investor, check out the VO. If you're an income investor, here is our advice for you. It has to do with big dividends. Okay, so many people want income. A lot of people love the idea of going on autopilot, having their companies pay them out dividends and income. Maybe the businesses keep growing, everything is terrific, that's great. You get more of a return than bonds, and maybe things keep growing, but it's also riskier, much riskier than bonds, than treasury bonds. Okay, the thing is, companies know that people like big dividends. And so when you see a dividend over, let's say like 6% or more, that's when you should say, that's a pretty high dividend. And so you don't have to say no to that stock, but you should be saying, now there's something I should be recognizing about this stock where it's not perfect, and I should be deciding whether it's something I want to do or not. Okay, first of all, dividends, basically three different kinds. You have qualified dividends, non-qualified dividends, and then distributions, which are not really dividends. Okay, a qualified dividend would be like an energy company like Exxon, or a retailer like Walgreens, or a drug company like Lilly, or an industrial like Caterpillar, or a utility like Duke Energy. All these regular businesses that just pay a dividend. Okay, that's fine. There's also, and you would generally want those in like your regular account where you would probably pay taxes on them because you pay less taxes on qualified dividends. That's why they're qualified. There's also unqualified dividends. This is for business development companies and real estate investment trusts. When those companies are set up, they're set up as special tax vehicles. They pay out more than 90% of their income as dividends, and then so they don't pay any taxes at all, but then you get those dividends and you do pay taxes on them. So those are non-qualified dividends. You generally want those in your IRA. Okay, there's also master limited partnerships, which are designed to give you income which you wouldn't pay income tax on. It's qualified as a return of your original investment. If the company's well run and does it right, then you won't pay taxes on those. So you generally want those outside of your retirement account. Okay. For big dividends, like we said, you should be looking for something that's wrong and say, okay, I know that this is probably a little bit high here, but if I can recognize what's wrong with this and say it's okay, then it's okay. Two that I'm going to give you are government properties, and HPT. Those are two REITs run by the Portnoys, this family called the Portnoys. Okay, and so the reason that Gov pays 7.5% and HPT pays 6% is because they're run by the Portnoys. The Portnoys have they're big inside owners. Some people will accuse them of running their companies to serve themselves, and maybe it's true, maybe it's not. I got familiar with this story when I wrote the Travel Centers of America article. The Portnoys are involved there, and Travel Centers of America leases its locations from HPT, the Real Estate Investment Trust. And these are excellent locations. But people say, well, you know, these Portnoys, they might run this business in a self-serving way, and I'm kind of scared of that. And they might run it in a self-serving way. So that's what you want to know about those two. That's what's wrong with them. Gov and HPT, okay, they got perhaps this self-serving, the self-serving controlling interest. Why would you like Gov and HPT in the first place? HPT owns these irreplaceable locations along the interstate with these travel centers. They got really good leases, getting good rents on those. They help Travel Centers of America build out more non-fuel services in these locations. They even get a little bit of the income off of that as well. They also own a lot of hotels and have the same deal. They help the hotels build out amenities and things like that, loan them some money, and they get a little bit more back on the rent. So that's a good business. And so that HPT pays about 6%. Gov is an even more interesting business. If you own Gov, literally the IRS is paying you rent. They own the building that the IRS is in. They own a lot of government buildings, state and local and federal government buildings. They also own a lot of other just regular real estate. Gov, as a good example of what the Portnoys might do, the Portnoys got into a little bit of a trouble with another REIT, and they made Gov buy the assets of that other REIT. Now, these were good assets. It wasn't a bad deal, but they were not government assets. So you might say, okay. So the big thing with Gov and HPT to me is that the Portnoys are large owners. They're real money, like tens of millions of dollars in each one. And they're paying themselves big fat dividends. And so maybe they just like big fat dividends. So watch the Portnoys, Barry and Adam Portnoy. If they start selling out, look for an HPT and Gov, look for SEC Form 4. If it ever comes in and says they're selling, sell it all right away. But I think those two are both fine. You know why you're not supposed to like it, why that dividend's that high, why it wouldn't be bought up so much. The port noise, okay, I can live with the port noise. They're, as long as they're on my side, as long as they're trying to pay themselves big dividends, you also can be there sitting with them getting those big dividends. When they leave, you leave. So there's two dividend stocks with big dividends that I'll say that pass muster for me. Okay. Those are unqualified dividends because they're REITs. Three qualified dividends I'll give you is Hershey. Hershey is the #1 chocolates here in America. There's a terrific business. Their dividend is like 2%. Well, that's generally like the best dividends are around 2% because they were paying the dividend, they raised it and they raised it and they raised it. It's not their fault their stock got bid up so much. So they're probably like the healthiest dividend payer. Cracker Barrel is another one. Compass Minerals is another one. They're raising their dividends. The dividends look good. The stocks get bid up so much that that Cracker Barrel has a 3% dividend. Compass is a little under 3. Hershey's down to 2. But hey, it's not their fault that their stocks got bid up that much. Those are like the healthiest dividends. So what you want to do is sort of have a bit of a variety. If you're looking for income, still you want to have that Hershey, and even though it's only 2%, you want to have Cracker Barrel and Compass, because in 5 years, they'll, maybe those will be maybe not double, but in 10 years, maybe those dividends will be doubled, and HBT and Gov might be sitting still. The big dividend payers may tend to sit still, whereas these healthy companies can keep growing them. So try to make a mixture of growth dividends and some that have a little bit higher of a at the time dividend. All right, I hope you found that helpful. Email questions@streetexclusive.com. For the Wall Street Exclusive, I'm Joe Springer, helping you make informed decisions so you can succeed in the market.